It's time for In the Money, stock market action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everyone. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. It's a pleasure to be here with you on this Sunday, just like every Sunday from 12 p.m. to 1 p.m. Eastern Time, giving you everything you need to profit in the stock market in the coming week. I think it's extremely important, and I want to stress this. This show is not meant to be the normal nonsense that's put out there. You know, whether you're looking at, TV financial shows or other radio shows, my goal isn't to just give you the vanilla, the plain vanilla of what everyone else is giving you. I'm here to unveil and unmask and give you the inside scoop so you can make an informed, logical decision on your next investment. All right. I'm here to give you insight analysis and projections that the hedge funds and big banks and institutions pay millions of dollars a year for. All right, it's kind of like my life's work now, I think, to kind of help the average investor start profiting, taking back the money that was taken from them in the financial collapses. These big banks were just bailed out over and over again. And think about that. Were the retirees that had all their money invested bailed out? No, but the big banks were. And again, too big to fail, right? Too big to fail. How many times have we heard that nonsense? Yet, is anything different today? I mean, that was in 2007, 8, 9, and there was this big uproar about creating a system where no bank is too big to fail, so we don't have to spend our tax dollars in bailing them out. But honestly, these big banks, they're bigger than ever, folks. And again, something will happen in the future, and guess who gets to bail them out? You and me. So it's all about kind of being aware of this kind of thing and putting yourself in a position where when there's a lot of hype on a stock, I want you guys to step back and recognize its hype. And you shouldn't be buying at all-time highs like on Twitter over the past month or two or on other stocks out there, which we'll go over a little bit later today. Instead, sit back, recognize the hype, and say, hey, listen, this is being generated by the institution so they can sell their positions into you buying. And you don't want to be a bag holder, which is what it's called when you buy at the top and you hold as it falls. You want to wait for that pullback, wait for that drop, and then find a logical, smart, intelligent entry point to get into that stock. All right, it has to make sense. Anytime you make an emotional decision, I would say 9 out of 10 at least it's going to be wrong. Granted, once in a blue moon you'll be lucky, but again, luck is not why you're investing in the stock market. All right, if I were to have someone come to me and say, oh, I just kind of gamble in the stock market, or investing's gambling, or trading's gambling, I would turn to them and I would say, listen, why are you bothering? Why not use that money and go have some fun with it? Get something out of it instead of watching it drop and kind of to go negative and down to zero. All right? Instead, go to the casino even. I mean, there's gambling. At least there the odds are against you. In the market, they portray like, hey, if you're an investor and, you follow the media and the analysts, you'll make money. You'll make money, sure. Well, that really doesn't happen very often. Granted, if you're in a year like 2013, sure. In a year like 2013, the market goes up 30%. It's hard not to make money. But I'm telling you right now, that's a deliberate ploy. And again, the small investor is buying towards the end of the run from 2009 to 2013, where the markets were up 150%. The small investor is buying at the end of that. And again, who's selling into them? Think about that logically. Who is unloading their positions as the small investors buying? And I talked about this in the last couple of weeks, and it's just so important that I need to reiterate it again. All right, margin. All right, everyone know what margin is? Margin is the amount of money being borrowed to buy stocks. All-time highs right now and over the last few months. All-time highs. And we're only talking about, when you're talking about all-time highs on margin, we're talking about the small investor borrowing. I mean, think about that. It's almost reminding me of the real estate market, how people were just leveraging themselves, putting zero money down and jumping in. I mean, you never want to see that. And as an investor, I want each and every one of you now, each and every one of you, to step back and say, hey, listen, let me look at what's going on. Oh, wait a minute, everyone else is going into the market now. Maybe this is the time where I become more conservative. All right, and literally over the last couple weeks, I gave you guys the exact high on the market and the exact bounce level last week on the market. And we're going to cover those too. But just think about that. Think about what I'm here doing. I'm giving you guys the exact levels on the market, where they're going to go up to, where they're going to fall to, and where they're going to bounce to. All right, there's no one else out there doing that. All right, yeah, sure, maybe the institutions are paying people, a few $1,000,000 a year to give them the same advice, but I'm giving it right here on 820 AM News Talk Radio for In the Money Stock Market Action, my show where, again, I'm dedicating it to each and every one of you, trying to help you avoid the hype on Wall Street and finally profit in the market. And when I say profit in the market, I don't mean, in 2013, just go long and hold. That's easy. I'm saying now that we're in 2014, now that you see the volatility, now that the Fed is tapering their quantitative easing policy, right, pulling back on money, that's what I'm talking about, folks. I'm talking about in this type of market, can you still make money? All right, I'm going to tell you a stat right now, folks. Now, I'm a day trader and a swing trader. What's a day trader? A day trader gets in and out of stocks very, very quickly when they see disparities. So I'll see some sort of chart, and I use charts, obviously, to trade, and I'm looking at a chart as it's falling. A stock price is falling, and it happens to hit, let's say, a 200 moving average, which is the last 200 closing prices on that daily chart, let's say, and it's the average of those. So there's the theory behind it, essentially. But if I see that, what I do is I jump in on the long side right there as it's coming down into that point, and I'll get 20 cents out of it, 50 cents out of it, whatever it is, and I just grab the money off the table in a matter of seconds to a minute or two. All right, that's day trading, and there are a lot of day traders out there, although it's one of the hardest careers. There's less pro day traders out there than professional athletes. Think about that. So it's a hard thing to learn. If you can learn it, you profit for the rest of your life. All right, swing trading. What's swing trading? Swing trading is where you buy a stock at a particular level, and you hold it for a few days to a week or two. And the idea is to make 5-10% generally off that investment and then just move out. And the whole idea here is that you're just doing this over and over again. And for those of you that work 9 to 5, swing trading is really where you'd fall into. You basically set your prices and you forget them. You set your buy entry when you get filled, you set your exit, and you have your stop in there, and you just walk away. And you say, all right, well, based on the chart, this is a high probability trade. And that goes back to what I was saying before. This isn't about gambling. Investing should never be gambling. You should be smart enough, learn enough, get educated enough to be able to find these levels very easily, or you come to me and I help you at InTheMoneyStocks.com, and you find these levels, and this way you can just buy and sell very easily, making 5-10%. We don't look to hit home runs. The average investor, jumps in a small cap, for instance, and they're like, oh, I'm going to make 200%. I don't even think about that, because that's like the once in the blue moon. That's like trying to hit a home run in baseball. You step up to the plate, you try to swing for a home run, you strike out usually. Striking out in the markets is not acceptable, frankly, because it means you're losing money. Now, do I ever lose money? Absolutely I do. Many times I do. But compared to what I'm making and how many times I'm making money on trades, it is minuscule. And it's about putting those odds in your favor. That's all it is about. So that's what I'm here to do, folks. I want to get you guys on the right path. I want to put you guys in a position to profit and ultimately unveil Wall Street's shady activities, okay? And what I was going to tell you before is this. All right, so I have a day trading account, right? Day trading account, and starting the year was about $85,000 in there. Okay, using what I do, using these methods, all right, I made over $40,000 in January. And you might say, well, how did you do that? Because the markets, were up and down, and they've come down about 5% or 3% off those highs. I don't understand. It's not like the market in 2013, where it went straight up. But the bottom line is, folks, is that when you recognize the scams of Wall Street, what they're trying to do and what they're trying to get you to do, and you start doing the opposite, and that's all it is, really. It's basically every urge you have as an average investor, you should be doing the opposite. When you're freaking out and you're saying, I got to get in this stock because I'm going to miss the boat, and it's already up 50%, but I think it's going to go up another 100%, that's the same time you have to step back and say, whoa, that's emotion. I got to now do the opposite of that. So either stay out or even go short, which is betting that it's going to go down, and you make money that way. So these type of things, folks, if you do them correctly, you can make a lot of money. And just in January alone, day trading, all right, I made almost 50% on my day trading account. Swing trading, we had an awesome month as well at InTheMoneyStocks.com. And again, there's a 7-day free trial there. If any of you are interested, you're going to focus on the research center at InTheMoneyStocks.com. All right, by focusing on that, essentially, that's going to be where most of you are going to fall into. If you ever want to get into day trading, you can test it out. But again, that's something that you have to really be dedicated to for a longer period of time, all day kind of thing. Otherwise, you have no shot at getting to the point of success on that mode. All right. On that note, I'm going to step aside here, guys. We're going to take our first commercial break. But when I come back, we're going to start looking at last week's market action and we're going to look at exactly where the market went, what it did, and how to profit from it in the coming week. All right, once again, this is In the Money Stock Market Action on 820 AM News Talk Radio. I will talk to you in a minute.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
All right, everyone, back on here at In the Money Stock Market Action. Again, my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Now, what I want to do now in this segment here is really go over the market last week because, I mean, listen, this is the bottom line. All right, it's great for me to talk about what the Wall Street shadiness is and all that, but we want to get into how you can profit and how you can kind of analyze last week to understand what could be in store for this week. All right, and of course, later in the show, I will be giving you my next picks, my next trade alerts for this coming week. I have a few of them for you. Last week, we gave out actually 5 in total. I had my business partner, Chief Market Strategist Nick Santiago with me. He gave out one. It never triggered. I gave out GE, which never triggered. But I did give out the S&P 500 at 1775. All right, and guess what, folks? Literally Monday, the day after I gave you guys that level, the market came down to that exact level and bounced. And I said, listen, if the S&P gets to 1775, that's your point to be a buy, and the market should bounce off of that. And what's amazing about it is I gave you guys that exact level. It hits it Monday, and the rest of the week, it bounced up, hammered on that level again, bounced up, hammered on that level again, and bounced up again, and ultimately closed up nicely off of that level into Friday. And again, you might say, how does he find these levels? How does he know this stuff? And this is years and years of analyzing and kind of unmasking Wall Street. And when you do that, you do start to get a feel for where the market is going to fall to or where it's going to go up to. And that's really all I'm doing. And again, over time, my hope is to teach each and every one of you to find these levels so you're never, ever on the wrong side again. All right, there's a reason why the first show I ever did, which was the first Sunday of 2014 in January, I said, listen, we're at the 1850 level on the S&P 500, and there's major selling by institutions. This market's at a major resistance point. It is going to fall. And sure enough, what's happened? We've fallen. Think about that. On the S&P, I gave 1850 as a drop level, and we fell, and I said, listen, watch for 1775. What did we do? We fell all the way from 1850 on the S&P to 1775, and that's where you find this market just above right now as we go into Monday tomorrow. Okay, and by the way, happy Super Bowl Sunday to each and every one of you. Good luck if you're a fan of either team. I'm neither a big fan of either team, but I will be watching the game as it looks exciting. It should be a great game out there, and I'll be eating lots of food as well, as always. All right, a couple other things. So number one, last week the market came down right into that 1775 level and bounced. All right, now the bounce actually hasn't been that substantial. All right, if I go to the S&P right now, and I'm just taking a look on my charts, we closed at 1782.59, so we bounced about 7.5 points off of that level by Friday. But either way, that was a good call about support of where this market would establish itself. All right, now what happened last week? Why are we continuing to see so much volatility in the markets? All right, and the answer is very simple. It just comes down to the Federal Reserve. And I know the media is going to spew a lot of other things to you. You're going to hear about Turkey. You're going to hear about Argentina and the currency crisis there, which they are having. I'll be the first one to admit it. You're going to hear about poor earnings. I've been talking about poor earnings for the last month to you guys, and the media is going to now tell you, oh, that's the cause of this because earnings aren't that great. All right, you're going to hear about a lot of different issues out there, but it all comes back to the Federal Reserve, and I'm going to tell you why. All right, because the Federal Reserve has been printing literally trillions of dollars basically for the last 4 or 5 years, to the point where they've printed about $4 trillion since the 2007 financial collapse began. Think about that, $4 trillion of just money printed out of thin air. And by the way, that's what's happening there. All right, they don't work for it. They just click a couple computer buttons and voila, there's $1 trillion. Well, wouldn't it be nice if we could all do that, right? Well, again, my hope is that if you learn how to trade and invest properly, you can almost do that. Now, we do it a lot more ethically than the Federal Reserve, in my opinion. But, that's essentially what we can do is create some money in our accounts by doing the right thing. In any case, the Federal Reserve creates money out of thin air and plugs it into the market, ultimately to try to save the economy. That's really what their goal was, or what their stated goal was. Whether or not that's true, that's up in the air. They state their goals. I think a lot of people would disagree that that's not their actual motives. But in any case, it all comes back to the Fed and printing. Why? Well, because the earnings haven't really been that great over the last few years, frankly. And there's been issues across the globe. We've heard about China's economic news being poor, for the last year or so, and that didn't really matter. Again, these earnings announcements didn't really matter over the last couple quarters, but now all of a sudden they're starting to matter. Why is the market paying attention to them? And again, the answer is this. The Federal Reserve has started to pull back on their money printing. All right, I want to give an analogy here that I think is very appropriate. All right, think of the Federal Reserve as the parents and the stock market as the kid. All right, now, over the last few years, the parents have been giving a big allowance, let's say $1,000 a month, really big, outrageous, $1,000 a month to the market to spend, to their child to spend. And what's been going on? Well, we've been seeing that the child's been really happy. Nothing can bring that child down because he can buy anything he wants. He can go out and buy this toy, that toy, buy whatever he needs to do. Everything is perfect. So the child is just happy and go lucky because he has so much money. Well, all of a sudden, the parents decide to cut back on that money that they're giving their child. Well, guess what? How does the child react? How does the child react? Not very well, right? All of a sudden, they're getting squeezed. That child's feeling it. They can't buy the same toys they could buy before. They can't go out and do the same things they could do before, and they're throwing a fit. And that's what the markets are doing. And again, all these issues around the globe, the currency issues in Argentina and Turkey, it's all stemming because the Federal Reserve's policies of printing this much money out of thin air, and they're now drawing back, it's causing a ripple effect. All right, think about dropping a quarter into a bathtub of water or a sink of water or whatever. You get those ripples, right? And that's what's happening. So now the big question is, does the Federal Reserve have any, responsibility for what's been going on around the globe? And the answer is yes, they do. Although it's funny to hear them now. You're hearing them say, oh, we're not the bank of the world. We're not this, we're not that. Yeah, but the policies you enacted have consequences that are far-reaching. And that's what's a kicker here. Another good analogy about the Fed, think about this one. This one might draw, a little bit more of a striking, analogy to you guys in understanding it. Think about a drug addict. All right, a drug addict that's been on drugs for a long, long time. All of a sudden, the drugs stop or the drugs get pulled back. What happens? Well, they go into withdrawal, right? I mean, think about the violent, body shock that happens on that withdrawal. And that's what's going on to the market. So now all of a sudden the market doesn't have the drugs being injected into its arm anymore. And the market has to now pay attention to these other factors which aren't that good. Reality's starting to come back, and the market's saying, uh-oh, the drugs are stopping. I got to pay attention to reality again, and things aren't as good as I saw or I thought. Now reality is striking back. So that's really what we're seeing here, folks, more and more. And again, all these issues around the globe are going to become of more importance. In addition, anytime you draw back this money, there has to be some sort of give and take, right? All right, so when the Fed was printing $4 trillion, the stock market inflated, and it became a bubble. I mean, there's no denying it. It wasn't I don't consider it a huge bubble, but it is a little bit of a bubble. And ultimately, now the bubble has to deflate. Now the question is, will the Fed come in at some point if the markets drop enough and start producing money again and printing money? But again, it's just amazing to see that. In any case, that's really what's going on here. All right, and the unintended consequences, I think, are something that we're now starting to see around the globe. And you'll see it more and more. And it's interesting because I don't know if you guys recall what happened a couple of years ago in Europe where you had Greece and Spain and Italy and Portugal and a lot of these countries, Ireland, they almost got to the point of collapse, all right, because they have so much debt, okay? Well, they were small economies. The one thing I want to just mention to you is that granted, the U.S. is the strongest of the group, but there will be a reckoning day. There's no way you can have this much debt out there without dealing with it, where the Fed is just printing reckless money like this, which, by the way, is hurting each and every one of us with inflation. I mean, there's no way you can have that and it not eventually have some sort of reckoning day. So just be aware of that, folks. And again, I'm not here to scare you. I want you guys just to see the truth. Now, as a swing trader, as someone who invests, how do I handle this? Well, I'm going to be a buyer and I'm going to be a seller when the time is right. And that's the key, is we just want to really ultimately focus in on the markets and decide when we need to buy. Like last week, guys, I said to you, all right, there's a couple things we want to buy. We want to buy the S&P at 1775. We want to buy RIG, which didn't turn out as well as I hope. We want to buy CORN at the current level, and that did it went up. I wouldn't call it doing very, very well, but it did go up as well. And these are the things you want to do. And there'll be a point in the future, very near future, where we're going to start to look to short this market again. And again, shorting, guys, is something that each and every one of you need to become accustomed to, because that's how you make money when the markets are collapsing. There were people that made billions, trillions of dollars when the markets collapsed in 2007, 8, and 9. All right? There's no reason why the average investor shouldn't be able to make some money as well. And I stress that because I really think that Wall Street has portrayed that shorting is something that the average person shouldn't do. Why? Because, you could lose unlimited amounts of money because a stock could go up, infinity. And if you're short, you have to continue to take those losses because you only make money when it goes down. You lose when it goes up when you short. But that's nonsense. This is what stops are for. All right, it's called having a little discipline in your life. If I'm in a short and it goes against me, there's a point where I cut that. And I say, all right, well, I lost $1,000 or I lost $2,000, whatever it may be. Same thing on the long side. If I'm buying a stock and it goes down on me, well, there's a certain point where I say, okay, I'm out. So it's give the average investor some credit here. But they don't want you to know this. They don't want you to be shorting the market because that's how they make a ton of money. And by the way, in 2007, a lot of the institutions got caught off guard. They absolutely did. But you know what? What do they care? They get bailed out. All right, oops, we made a mistake. We lost a lot of money. All right, government here, tax dollars, come bail us out. Thank you. All right, we'll do it again. Big deal. And that's what it is. But again, the average investor doesn't have that luxury, folks. That's why we need to take responsibility for our investments. Start paying more attention because in all fairness, that's your retirement. And that's a huge portion of your life. I assume none of us want to work till we're 80, 90, 100 years old. We want to retire at a decent age and enjoy life the rest of the way. Well, unless you're going to start paying attention to your investments, you have no shot. Because, again, the games that Wall Street plays, the shady practices, they are going to do everything they can to get you on the wrong side of the market. Just like last year, folks. Yes, it was up 30%, but I'll tell you, so many small investors finally got back invested in the market in 2013. And that's after the markets were up 100+%. Sure, they had another 30% up last year, but it's not going to make a hill of beans difference as the markets come crashing down the next time. And they're going to wait, and they're going to dump at the lows, take another loss while the institutions laugh all the way to the bank. All right, guys, we're going to be back. We have a guest coming up. This is In the Money Stock Market Action on 820 AM News Talk Radio. I'll talk to you in a minute.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody, as we get into the second half of the show today. And again, a lot of things I wish to discuss. I wish I even had more time to give you more information, but that's what I'm here for every Sunday on 820 AM News Talk Radio to give you guys that insight from 12 to 1 p.m. Eastern Time. All right, well, today, folks, we're bringing back a guest from last week. He's my business partner at InTheMoneyStocks.com, chief market strategist and investing genius, Nicholas Santiago. Welcome, Nick. How are you doing today?
No, I'm doing wonderful, Gareth. Thank you for having me on the program today.
Oh, truly a pleasure, man. Anytime. Now, a couple things I just want to discuss with you. Number one, what are you thinking about the markets this week? I mean, what are we looking at? Because last week we had this kind of market that bounced off the 1775 level, but it really hasn't gotten a huge bounce, not a big reflex bounce. So what do you think there?
Well, I think right now, as long as that level, which you mentioned, 1775, if traders are looking at the spiders, it would be around 177.15, 177.20. As long as that level holds, we're probably due for a short-term bounce. But ultimately, this sideways action, choppy sideways action, should lead to further downside in 2014.
Very cool. Very interesting. Now, a couple things about that. Number one, is it worth it being in a couple longs as a swing trade right now? You think that's an okay thing to be as long as we don't break that level?
I do. In fact, as you know, I have a few longs out there myself. I believe you do as well. And right now, we just need to protect ourselves with stop-loss orders just in case the market does go a little bit lower first. But generally, the first trading day of February is usually a bullish trading day. So, as short-term traders, we're looking for that quick little bounce off of a very good support level that's near-term at around the 1775 level, which you mentioned.
Yeah, one thing I think it's worth our listeners to kind of hear about is how the media is still portraying the market as a buy the dip mentality, and that'll keep kind of the average investor still getting in. Because remember, a lot of these average investors out there, they either got in late in 2013 or they missed it entirely as they were waiting for a pullback. So I think it's important to understand that you still have people on the sidelines that are waiting for the slightest pullback to jump on in. So as soon as you start seeing a little bit of buying, it can shoot back up just a little bit. But I definitely agree that the pattern formation right now and everything we're seeing is just continuing to tell us short-term bounce with bigger downside in the future. Absolutely. All right, so another question I had for you. I was doing some research on the Federal Reserve over the last couple days, and I know you're an expert on the Federal Reserve. So, you know, I was looking into it, and it's interesting how when I was reading about the Federal Reserve, it seems like the Fed was originally created to kind of, you know, supposedly break up the big banks. But the funny thing was the actual creators were the big banks themselves, big people like J.P. Morgan and Rothschild and a couple of the others. I mean, is that what you know about them?
Well, there are many owners to the Federal Reserve. They're the elitists, and J.P. Morgan was one of the founding fathers of the Federal Reserve. So basically, these banks have pretty much free reign. The big problem with the banks, and this has not been really talked about much, is whatever happened to those credit default swaps, or those all of those that bad paper that the banks are holding. How did they just magically disappear? Well, a couple of years ago, we had a change in the accounting standards for the banks. They went from mark to market to mark to model, and now they could model them any way they want. But the problem ultimately is even bigger. Back in 2010, I once heard somebody on CNBC say that the banks were holding $500 trillion worth of this bad paper. However, now I believe the amount is up to around 700 or 800 trillion. That's with a T. That's trillion. And you have a lot less players in the game now. These banks that were too big to fail are now too big to fail, but they're bigger. So there's a big issue here. And, you know, if you just go back and look at what Paul Volcker said, he was the last Fed chairman with any credibility. He said in 2010, if I may quote him, he said, if banking institutions are protected by the taxpayer and they are given free rein to speculate, I may not live long enough to see the crisis, but my soul is going to come back and haunt you. And, if that's not telling you something, I don't know what is.
Wow, that is amazing. And it's so interesting how what you were saying about, so basically these big banks, they were allowed to just change their accounting and magically. I mean, it's almost as if, I have a dollar here, but now a rule comes down from the Federal Reserve and these other big players that now that dollar I can just say, hey, man, it's worth $2 now, even though I still have a dollar.
Sure. Well, the banks may have a home that is in default, and it may be on their books. In the past, it would have to be written down as a liability. Now they could just mark it up, and it's now an asset.
Wow.
So, you've just changed the books from a negative book to a positive book in very, very quickly.
So basically, these guys are allowed to almost cook the books, and at the same time, what we're seeing is they're actually doubling down on what hurt them before with all these billions, trillions more in liabilities or default swaps and so forth.
Sure. In essence, Enron accounting is now legal.
Whoa. That's a pretty wild statement, but 100% accurate, folks. And I hope you all are listening in. And this is why, you have to be an educated investor out there. If you're not educated, you're not understanding this, and you're going to be caught on the wrong side when the next collapse happens. You need to be understanding of that. What happened in 2007, what happened in 2000, there's bubbles, and then they're bursting. And each one seems to me to be getting bigger and bigger, which is scary because it makes me wonder if at some point there's going to be an ultimate collapse, like epic collapse, even bigger. I mean, we thought financial crisis in 2007 was bad, but could it be even worse? And again, here the Fed is being an enabler. All right, they're the ones that are just continuing to bail this out. The legal system, our politicians. Yeah, sure. When the average American was crying out about too big to fail, sure they were talking about it. They were thinking about doing something. But honestly, nothing really happened because us as a community, as the United States citizens, we didn't stay riled up. Because you know what? The Federal Reserve pumped enough money into the system that the stock market went up, and now everything seems hunky-dory. But unbelievable stuff here, guys. All right, couple other questions, Nick, that I have for you. Number one, can you explain one of the key things that you use in everyday trading, whether you're investing or swing trading or day trading, called Fibonacci, and how it's kind of seen all over the world just naturally?
Yeah, Fibonacci sequences are everywhere in nature. In fact, Leonardo Fibonacci gets credit for the sequence, but they've been used by the ancient Egyptians, the ancient Greeks, and numerous other societies. Last year I took a trip to Ireland, to Newgrange, Ireland, and I was surprised to see how Fibonacci ratios were used back then, and that's a society that was 2,000 years older than the Egyptians. So if you take a look at the planetary structure, if you take a look at a seashell, a plant or a flower, everything is constructed in a perfect Fibonacci ratio, even the human body. So if a person is 7 feet tall or if they're 5 feet tall, they'll notice that the belly button, the navel, will be at an exact 0.618 ratio, and we call that the golden mean. So these ratios are around everywhere. In fact, even if you go and knock at a door, 3 is one of the ratios, one of the number sequences, and you'll notice that people knock on the door 3 times, 1, 2, 3. That's just a general knock because that's very, very comforting to the human body, which is genetically designed in this ratio.
Wow, that is amazing. So basically what you're saying is that it occurs everywhere in nature, and because it's surrounding us and nature naturally occurring, it occurs in charts as well on stocks. So actually, when we're using a Fibonacci retrace, for instance, we're looking for that same retrace, like the same as down to your navel would be on your body from your top of your head.
Yeah, exactly. I'll give you even a better example. If you just take the S&P spiders and you take the October 2013 low to the most recent high, which was made on January 15th, and you just look at where the market fell, it came right down to a perfect 0.382 retrace, which is one of the most important Fibonacci sequences.
Wow, that is awesome, folks. So just a heads up here. I mean, again, this is just something that we're presenting to you so that you can now become more informed. You don't have to rely on the media out there pumping a stock when it's up, 100% in the last 3 months, and you don't have to make that decision. Do I have to get in or should I get in? You can start using Fibonacci. Wait for a pullback to a key Fibonacci. And now, Nick, what are the Fibonacci levels again?
Well, there are many sequences to the Fibonacci ratios, but the most commonly used are the 0.382 retrace, the 50% retrace, and also the 0.618 retrace. But there are many other retrace levels. You could go to 1.382, 1.50, 1.618, and 2.382, and so forth. So it really never ends. But for trading purposes, the 382, the 618, and also the 0.50 are very, very important.
Oh, excellent. So just again, folks, always, keep in mind that we're going to bring you new things like this that you may have never heard of. But as a trader or as an investor, it will help you make an informed decision. And you can go to Google and look up Fibonacci and read more on it. We'll cover it in the coming weeks even more so and hopefully present a better, clearer view so you can even get a better feel about how to use it. Now, a couple other things I wanted to go over. Number one, so natural gas last week had a monster spike. I mean, just epic over the last week. Even over the last multi-months, it's been up huge. But one thing that kind of bothered me and that just kind of to me shows that shadiness of how the average American can get punished by stuff that goes on Wall Street, Nick, and I don't know if you heard this, but I heard that possibly there was a major player out there, a major hedge fund that was short natural gas, and essentially what was going on was he was getting squeezed out or just pushed out of his positions while the stock or while the commodity was surging to the upside. Anything that you heard on that, or does that happen?
Oh, it happens all the time. In fact, even another example of that was not too long ago in the gold market. The whole entire trading community knew that John Paulson was heavily long gold, and gold was just continuing to plummet. Gold mining stocks were plummeting. He was in so many of these major gold miners, and these stocks were just getting hammered to the downside. So when the Wall Street community, the big institutional money, knows that somebody has a big bet one way or the other, and they see the tide shifting, they're going to pound them the other way. In fact, you could look at Bill Ackman with his Herbalife short. Once the trading community knew that he was heavily short Herbalife, a large part of his account, I mean, you had guys like Carl Icahn and George Soros and many others join in on that Herbalife long trade, and they pushed that stock all the way up from the 30s all the way to the 80s. So it goes on all the time, and it's very, very important to just read the charts because just say, for instance, when you look at natural gas, our traders would never be buyers up there at that level because we know that that's almost, it's a parabolic move and it's unsustainable. So somebody is generally in trouble when that happens, and once the smoke clears and once that person is forced to exit that position because of their loss, that's when the market will resume back to normality.
So I think it's clear. So it's clear to our listeners here. I think I want to just focus in on the aspect that, you know, it just shows how Wall Street is so disconnected from the average investor. Because think about this, folks. So what we're saying to you is that a big hedge fund was most likely short natural gas, which meant they were betting it would go down, and the rest of Wall Street ganged up on them to push them or push the price of natural gas up to the point where they had to get out and take a huge loss. But what's going on there? So that's Wall Street playing their games. Guess what's happening at home? I mean, think about the price of natural gas, and I'm hearing about your bills on natural gas doubling in the next couple months. I mean, it's just, I mean, think about that. So these guys are having their fun, and they're making billions of dollars, and the average American is literally seeing their gas bill double. I mean, where is that even? I mean, that just blows my mind, Nick. I don't even know where to start on that one.
Well, it's pretty incredible, but I have news for people. This isn't just the first time this is happening. It's been going on throughout history. It went on before we even had markets in this country. It went on in foreign markets thousands of years ago, and it will always go on because it's just really part of human nature, and human nature never changes, as the great Jesse Livermore would say. Therefore, the stock market never changes.
Yeah, that Jesse Livermore is a great book, folks, and highly recommended to all our listeners. Nick, can you give us the title of that?
Sure. It's called World's Greatest Stock Trader by Jesse Livermore. And the reason why I'm always telling people to read that book, and the author is Richard Smitten, the reason why I tell people to read it is because you'll see what happened to Jesse Livermore when he broke his own rules. He was a trader that made over $100 million in 1929, and the guy literally died broke. So it just goes to show you what can happen when you break your own rules. And he was the world's greatest stock trader as far as I'm concerned. But again, to see somebody break their own rules and lose their fortune like that is really, it really can take its toll on your psychology. So I always tell people to read that book. I think anybody that's aspiring to be a trader should realize that you have to follow a strict set of rules, and discipline is really what trading's all about.
It's amazing commentary. Thank you so much, Nick. All right, folks, we're going to take a quick break here. I wanted to thank Chief Market Strategist Nicholas Santiago, my friend and business partner at InTheMoneyStocks.com, for giving us his insight today. And again, we'll be back here shortly. We're just going to take a quick commercial break. This is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Welcome back, everybody. Glad to be with you here on this Super Bowl Sunday as we come into the final stretch on this February 2nd. So we're already in February. Amazing. 2014. So the first thing I'm going to start with is something that I've been kind of contemplating over the last day or two, and I think it's worth just bringing up briefly. And then what we're going to do is get into market projections, and I'm going to give out my new plays. We're going to discuss how much money was given to charity last week. That's, again, happening. If I'm wrong on any sort of trade that I give out, then I give $100 to charity. And my hope, again, folks, is to make sure the charity always wins. And that's key, folks. As we make money, as I make money in the markets, we all have to be giving back. And that's one of the big things that I'm striving for in this radio show, is to start a movement. All right, there's a lot of big banks out there. I don't think they give their fair share back. They have shareholders they have to, I guess, answer to, but that's no excuse. And I'm just one person, but I'm going to make sure I give back, and I'm going to try to influence and help you guys make money so you can give back as well. All right, the first thing I wanted to discuss before we get into those trades of the week and going over last week's trades is the minimum wage. All right, so we all know the minimum wage. There's been a lot of talk about raising it to $10. Federally, Obama raised it as well. Now, this is a very, very controversial topic because a lot of people are worried that it's going to cost a lot of jobs. Okay, and again, to be honest, I'm not 100% sure whether it's going to cost jobs or not. My guess is it wouldn't, because we're only talking about a couple dollars. But one thing I just want to bring to your attention is this. All right, when minimum wage is low, and when someone, and in all fairness, someone making $7, $8 an hour, there's no way by themselves they're feeding their family. I mean, it just doesn't happen in these day and ages in this country, okay? But what I want everyone just to realize is that when someone has to go on public assistance food stamps, guess who's paying for that? That's everyone's tax dollars. Okay, so think about this, and this is the only thing I want to say about this, but I want you to just think about it, all right? If a big bank pays a teller a certain amount of money, and they don't make much money, or if McDonald's pays one of its servers, its register people, a certain amount of money, let's say minimum wage, and they have to go on food stamps to supplement, that means you're paying their salary. All right, now let me ask you this. Big banks, we bailed them out with our tax dollars. All right, the Federal Reserve gives them free money. All right, why can they not pay out of their pockets, out of their $2-3 billion profits every quarter, $3 more to those people? Just 3 more, probably amount to 50 million, 20 million, 10 million. All right, that's out of billions in profits. All right, I'd much rather those big corporations that make billions in profits pay their employees a little bit more so that your tax dollars and my tax dollars don't have to supplement that. And that's what's happening. That is what is happening. Okay? And that goes for these banks that pay their tellers too little. These goes for McDonald's, all these corporations. Okay? And do we really think they're going to shut down a McDonald's because they got to, raise, minimum wage a couple dollars? No. They're making billions of dollars every single year, and they're just keeping it for their shareholders so their stock price stays up while you and me are supplementing them. All right? We're supplementing those employees. So on that situation, when you look at it from that perspective, I got to be honest with you. I'm for raising the minimum wage. And it may not be popular because there's a lot of brainwashed people out there. All right? But it's got to be done because our tax dollars should be put towards other things where, you know what, cut taxes. I'd love that. All right, at least put that money towards helping other people in need. I don't know, do something better with it than instead supplementing big corporations. All right, guys, let's get on to some market projections for next week. I had my little spiel there, and enough's enough of that. All right. So last week, again, I came to you guys with some plays. 3 of the plays triggered. I gave out 4. My partner gave out Nick Santiago, Chief Market Strategist at InTheMoneyStocks, who was just on with us. And thank you again, Nick, for that. He just gave us out that Costco trade, but it never triggered at his level. So we only had 3 triggered trades last week. All right, one was corn, C-O-R-N. That continued to move higher. So that was in the money. Very nice. The S&P 500, I gave you the exact level that it would trigger at 1775. It came down to that level the very next day, hit it, and bounced. And by the end of the week, it did close above. So that was a winner as well. And then I did give out one that did not perform as well as I would have liked, which was RIG, Transocean. And that stock did fall from 44.25 per last Friday's close to this Friday's close at 43.28. So on that note, $100 from me goes to Metropolitan Ministries, the charity that I selected last week. And again, I wanted to thank Mark last week, who called up and donated $150 after making $1,500 on my calls. And I encourage you guys, if you are playing any of these trades, just give a little back. All right, I'm giving you stuff that literally hedge funds and Wall Street pay millions of dollars for every year, this information. And all I ask is that we take the money like Robin Hood back from the institutions and then bring it back and just give a little bit to someone less fortunate. All right, it's karma. It comes around tenfold. And again, proof is in the pudding as those of us that do give get it back in spades. All right. Let's go on to the picks for this week, folks. To make sure to get that in, I want you guys to be fully aware. By the way, I do have one quarterly play that's still in play, which is JCPenney. And basically what I said to you guys is, if I'm wrong on that one, I donate at the end of the quarter $500. And so far it's down a little bit, but I think by the end of the quarter it's going to right the ship. And I still like that quite a bit. And again, if it closes above, then great. Hopefully some of you guys made money on JCPenney. JCP is the symbol there. And if not, then again, I donate $500 for that quarterly play at the end of the quarter. All right, so the picks for this week, guys. So far, the analysis on the market is very it's not as clear as last week, I'm going to be honest with you. All right, because we came down to the exact level. I would have liked to have seen a little bit more of a bounce last week. We didn't get that. But what Nick said is the same thing that I feel, which is as long as you're above that 1770, 1775 level on the S&P, and I'm talking about on a closing basis at the end of the day, as long as you're above that, then the market still has a chance to bounce higher. Okay, so again, I'm going to be neutral to positive on the markets for this coming week, expecting potential upside. But make sure that you understand, at the end of a day, if you close on the S&P below 1770, then go bearish. All right, then you expect the markets to fall and continue to fall. That is the big level. That's the bogey. That's what you're watching. 1770 to 75 on the S&P 500. As long as we're above it, neutral to positive bias, look for a little bit more bounce action. If we get below it on a closing basis, downside should come very quickly. All right, the plays of the week, folks. Number one, SINA, S-I-N-A. All right, S-I-N-A. Now, I'm going to give you guys, even though some of the levels are just a few pennies below where the current price is, I'm still going to give it to you as of Friday's close. And SINA, S-I-N-A, is a Chinese player. It's had a big sell-off. I think especially as long as the markets don't break that 1770 on the S&P, we should see a bounce. And the entry price per Friday's close will be used as $65.19. Next one, corn. I've stuck with this every week really since the beginning, and it's basically performed very well. It's not making us a fortune, but it's slow and steady wins the race. I still like the chart on CORN, so I'm going to stick with it. And the price this week that it has to stay above is $30.90, which was the closing price on Friday. So long or buy CORN. So SINA, S-I-N-A, corn, C-O-R-N, both longs there. The next one is Chevron. Chevron got beaten down after missing earnings a little bit last week. It's had a big fall. It should bounce. I have a current level of support a little bit below where we currently closed on Friday, but I'm going to give it to you guys as of the close. All right, we're just going to use that. It's simpler that way. If you guys want to wait for a little bit of a dip, that's fine on it, but for me, I'm just going to keep it as simple as possible with you guys. I don't mind if I donate a little bit of money to charity because I'm not being a stickler for the entry price, okay? Next one, I have Freeport-McMoRan, FCX, 32.41 on the long side. So every play I'm giving out this week is a long play. That doesn't mean the market has huge upside, by the way. I want to make sure everyone understands that. All right, but at this point, I feel more confident. Even though it's not as confident as last week, I feel more confident to be on the long side of this market than short as long as we hold that level. And again, Freeport FCX, Freeport-McMoRan, 32.41 to the long side or the buy side. Last one I'm giving you is Molycorp MCP, $4.85. It's a little bit of a smaller one, but I like it down here. It seems cheap. And again, if we do get a little bit of a bounce this week, we should see a move up. Now, again, folks, the big key here is just the market's holding above that level. As long as we hold above that level, this market should do very well and bounce back. It's not going to new highs, though. I want to be clear on that. The Fed tapering is showing the open wounds of this market finally, and tapering is where they're pulling back on the money they're printing. All right, for you and me, I think over the long term, thank goodness they're pulling back on money, on the amount of money they're printing, because their printing money dilutes our money in our pocket. Our dollar, which was worth 100 pennies, 2 years ago, is now probably worth 95 cents today. That means our buying power is decreasing. So I like the fact that the Fed is tapering, but because the Fed printing money inflated the markets like a bubble, there has to be some of that hot air that comes out of it, which is why overall we do expect further downside, even if you get small bounces along the way. My goal here again, guys, is to make sure we're getting in these plays and we're getting in at the right time, and you guys are understanding the tricks of Wall Street. All right, guys, a couple things to go over here. All right, I just wanted to relay to you one of the keys or a couple of the keys to looking at the charts and how I decide what a good investment is. The number one thing I look for is where it's located on the chart. So a chart is just a stock price moving up and down. You can bring up a chart on pretty much anything. But what I want you guys to do this week, if you're looking at a chart, I want you to just look and say to me or say to yourselves, is it trading at the highs of the chart or at the lows of the chart? All right, if it's trading at the lows, you want to do more research. If it's trading at all-time highs, you don't want to think about buying that. If it's trading at all-time highs, you can think about shorting it. But again, you need to know more about it before you make that decision. All right, so first of all, is the chart high or low? That's number one. Check that off. All right, if it's high again, you don't want to be long it. You don't want to buy it. If it's low, you might think about it, depending on, again, what's going on there. You have to do a little more research. All right, analyze market conditions. And we're just about done here, folks, but analyze the market conditions. Find out, is it a good market or a bad market? If it's a bad market, don't buy anything. Just be very careful. All right, I got to get going, guys. It's Super Bowl Sunday. It's going to be a fun day. I'm going to go get some food, sit down, maybe have a beer or two, and enjoy the day. Thank you all for coming out here. This is In the Money Stock Market Action. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and this is 820 AM News Talk Radio. Take care.